It's Sunday, January 5th, 2020. I almost said 2019. Happy New Year. Welcome to All About Your Benjamins and your weekly mixtape and weekend review video. Short week with the holiday there in the middle, but it was a busy week of news. Obviously, there's a very big headline playing out right now, but let's start with the beginning of the week and work our way to the most recent event, which is the biggest one. So the year ended with the stocks on a high note. The S&P, the Dow, all of the U.S. benchmarks did very well, 28-30% depending on which one you're looking at. And 2019 was a year that pretty much everything worked. If you were invested, your investments probably did pretty good. If you're diversified, you could have picked a bad stock and not had that experience. But if you were in a diversified fund, you probably did pretty well last year. Not that that's always going to happen. So who knows what 2020 has. But because we don't know, and because years like last year are unpredictable, that is what is a reason for having a diversified portfolio. Trying to say, U.S. stocks are going to continue to do the best, we don't know. So the proven way is to have a diversified portfolio and lean on your financial planning and your behaviors and the things you can control and just be in the market, spread that risk around. I don't think I'm ever going to change my tune when it comes to that. But the other thing to remind yourself is also if you had a diversified portfolio last year, you probably did not do as well as the benchmarks did. Now I mentioned this last week, but again, being diversified means yes, you have those S&P stocks and those Dow stocks in your portfolio, but you also have the small and mid, the international and the bonds. And while all of those did well last year, they didn't quite do as well as large US, so it's going to bring your return down, but you still should have done very well. And at this stage of the game, what is your goal? If you're a retiree, is it to make the most money possible? Probably not. It's probably to grow your portfolio, keep up with inflation, maybe have some legacy goals. That's what you need to do. Maybe you can take on less risk and still be able to do that. If you're young, yes, you want to be a little bit more aggressive, but you want to just be in the market, let the market do the work for you, and then focus on how can you increase your earnings, how can you do better savings, how can you pay down debt. So in any case, you're probably better off with a diversified portfolio, saving and letting it do the work for you, and being okay with being diversified, meaning you're not going to be the highest performing portfolio possible, but that's okay. So the year was great. We'll see what 2020 has in store for us. At the end of the year also, President Trump, we go back to the China trade war, announced that he would be signing the phase 1 deal with China on January 15th. Now, a lot has happened since December 31st, so we'll see if that actually continues, but it looks like some of the momentum with the trade deal might actually be moving forward. I'm still a little skeptical just from the news headline trend that we saw last year of announcement, good news, bad news, that we saw with the China trade deal. This very well could be something that last minute we don't sign. So don't hold your breath, but it looks like it's heading in the right direction. Now to the big news deal, the drone attack in Iran killing the high-ranking commander, which was a response to some of the events going on towards the U.S. Embassy over there. But that bombing is the first major thing we've done over in the Middle East in a long time and has people concerned about a war erupting. You're seeing a lot of tweets and joking headlines about World War III, which I saw a tweet that made me think that while we're back here joking about this a little bit, there are people who are over there or getting ready to go over there, putting their lives at risk for us to be able to joke. So I didn't really think about that until I saw that, but maybe kind of pull back on some of those jokes because this is very real, this is very serious, there are lives on the line, but we don't know what's going to play out. So obviously it's not a move in the direction we want to see. We would rather see peace, but we'll see where this goes. There have been some threats, I would call them threats, that if there's retaliation that the U.S. will bomb Iran again. And there's 52 targets that have been picked out for the 52 U.S. People that they took hostage years ago. So a lot of things playing out in Twitter like usual, but those could have impacts on the market. Now, you're going to be in position to be able to come up with scenarios in your mind that may seem very real, that may make you want to change what you're doing when it comes to your investing. Or you may hear somebody on news that has a great point or a great argument that may cause you to want to make a change. These are momentary things. So yes, a war in the Middle East would be a very bad thing just in general. Who knows what it does to the economy, who knows what it does to the market, to consumer sentiment. But is it something that's going to change your long-term plan? Probably not, because if you've been saving for 20 years, you've been through wars before. You've been through events like this before, and it did not change where you're at today. It's a momentary thing. So there will be a lot of headlines that come out of this. There will be a lot of doom and gloom that will come out of it. There will be some bad news that is real that comes out of it. Before you make a change to your portfolio, maybe you should consult your financial advisor, talk through things, and see if anything has changed with your plan that may make you need to make a change. Chances are you probably should just sit still and not make a change. But that is for you and your financial advisor to decide. So again, a lot of headlines. This is not going to go away quietly right away, so we'll see how this plays out and what this impacts other things. But prior to that, the year started off to a pretty good note when it came to the stock market continuing last year's good run. So we'll see what happens. And finally, the last thing you're going to see in the Weekend Review articles is an article that has nothing to do with news headlines, but it was just one I thought was interesting that the Wall Street Journal has found that there are a lot of Americans taking money out of their homes using home equity lines to pay down debt. And the reason I bring this up just is it's beginning of the year. We're talking about budgeting. We have goals that we're going to do. We want to have savings goals. We want to pay down debt. Just that it appears that some of us have gotten back to overextending ourselves and running up credit card debt, buying things that we don't really have the ability to afford, and we're getting bailed out by being able to pull equity out of our house, which is not necessarily a bad thing. A home equity loan interest rate is usually lower than a credit card interest rate, so from that standpoint it's not bad, but it doesn't fix the behavior. I've seen it a number of times in my career. I've been doing this over 15 years now, that you do a home equity line of credit with good intentions of paying down that debt, you shift that over to a lower interest rate, but then all of a sudden over time those credit cards run right back up and we're not any better. So if you are somebody who is doing a smart thing by lowering your interest, make sure that you're doing some things to help the behavior that got you into that position, because that's just putting a band-aid on the wound that's not going to heal. You need to really address the issue, which is spending or earning more money. Not an easy thing to do, but that is the solution for a lot of people, is how can you make more money, then you don't have to cut back your lifestyle. So some people have trimmed all the fat. There's nothing more that they can do. A lot of us, we live a little bit of a luxury. You may not feel like you have, but if you really look at where you're spending your dollars, those are not needs, those are wants. So just put that in there just to give you something to think about as we go to the beginning of the year. Again, a lot of us have savings goals, a lot of us have debt paying goals. That this just shows that not all of us are following through with that. So not to be a negative, but just something to put there to think about. That's it for today. Be sure to subscribe if you're on YouTube. If you're listening to this on your Amazon device, head on over to YouTube. In the show notes will be the link to the blog, or you can go to allaboutyourbenjamins.com to see all of the articles about the things I talked about today, and also the great mixtape below of blog posts from other people around finance with a lot of great topics, a lot of great things to think about. So that is it for today. Thank you for watching. Again, please subscribe, share this around. Let's try to grow the viewership on this YouTube channel. We'd love to see those numbers grow, because that means I'm reaching more people and hopefully helping more people. So have a great day, and we'll see you next week.